Carol from Tennessee had done everything right. She and her husband, Jim, retired 5 years ago. They had dividend ETFs. They had income coming in every single month. They had a plan. Then the market started dropping. Week after week, the news was getting louder. Oil prices were climbing. Recession talk was everywhere. Jim said he wasn't worried. "It always comes back," he told her. Carol wasn't so sure. She sat down one evening, opened their brokerage account, and saw the number. Their portfolio was down $47,000 on paper. The dividends were still arriving, but something felt different about this time. She had one question she couldn't shake. Should we change anything? If you've had that thought recently, even for a moment, this video is for you. By the end of this video, you're going to know which 4 dividend ETFs are built to keep paying you through exactly this kind of market. You'll know how to structure them, and you'll understand one specific risk that almost nobody talks about, a risk that quietly destroys more retirement portfolios than any stock market crash. And here's the part most people miss. The most popular high-yield ETF on YouTube, the one promising 8% income, is actually shrinking your dividend every single year. I'm going to show you the numbers. Quick note before we go any further. I'm not a financial advisor or a government employee. Everything in this video is for educational purposes only. For your specific situation, always work with a qualified professional. Now, let's talk about what's actually happening out there. Before we get into the 4 ETFs, I need to address something. In my last video, I told you SCHD was the best single ETF for retirement income. The comments exploded. SCHD is down 34%. Morningstar called it the worst ETF. You'd need $2 million just to live off the dividends. Let me walk through each of these, because the truth is more interesting than the criticism. Here's the myth. SCHD is a broken ETF that no longer belongs in a retirement portfolio. Here's the truth. SCHD's dividend grew 5.35% in 2025. It never stopped paying, it never cut. The 34% drop never happened. Not in 2025. SCHD fell about 13% during last spring's tariff sell-off. That's it. The 34% figure comes from SCHD's all-time maximum drawdown during the COVID crash of March 2020. That was 5 years ago. The fund fully recovered. What about Morningstar calling it the worst ETF? That's not true either. Morningstar maintained a gold medalist rating on SCHD throughout all of 2025. Their analysts published an article in September titled "Why Schwab U.S. Dividend Equity ETF Remains Exceptional." 4 stars, gold medal. That doesn't sound like a broken fund. Now here's what was true. SCHD did underperform its peers for most of 2025. A 4.34% total return when the S&P 500 was up 17.9%. That's a real gap. The reason was simple. SCHD held very little in technology, and technology dominated 2025. That's not a flaw, that's the design. SCHD holds steady businesses that pay dividends, not fast-growing tech stocks. And here's where the story gets interesting. In 2026, the market rotated hard. Tech sold off, dividend and value stocks surged. SCHD is up roughly 15% year-to-date as of this recording. The S&P 500 is down about 3% in the same window. The investors who held on through the noise are now being rewarded. Patience. That is the word that defines dividend investing. But here's the uncomfortable question that the data raises. If you were only holding SCHD through all of this, were you actually protected? Because when I compared 4 specific ETFs side by side through the worst markets of the last decade, what I found changes how you should think about building a retirement portfolio. The silent risk that destroys retirements. Most retirement videos focus on the wrong danger. They talk about market crashes, bad years, volatility. And yes, those things are uncomfortable, but there is a quieter risk, a mathematical one, and it can permanently damage a retirement portfolio even if the market fully recovers. It's called sequence of returns risk. Here's how it works. Imagine two retirees, same average annual return over 20 years, same amount invested. But one of them experiences the bad years first in retirement, the other experiences the bad years late. The one who gets the bad years first runs out of money. The other one doesn't. Here is why. When markets drop and you are drawing down, taking money out to live, you are forced to sell shares at low prices. You lock in those losses. When the market recovers, you have fewer shares to recover with. The math never catches up. This is the risk that doesn't make headlines, but it ends more retirements than any single crash. Now, here's the part that should make you feel better. Dividend income short-circuits this trap. When your portfolio pays you cash every quarter, every month, you don't have to sell shares to cover your expenses. You let the prices move, you collect the income, you wait. Here's a number that makes this real. Since World War II, the U.S. has gone through 13 recessions. During those recessions, stock prices fell an average of 32%. Dividend payments fell an average of just 4%. 32% on prices, 4% on income. That gap right there is your retirement safety margin. That is why dividend ETFs exist. But not all dividend ETFs protect you equally. The income stability in a downturn depends entirely on what the fund owns, how it's built, and what it costs. And that's where the comparison gets very interesting. Before I show you the hidden cost inside the most popular high-yield ETF on YouTube, drop a comment right now. Are you already living off dividends, or are you still in the building phase? I read every comment, and your answer tells me exactly which of these 4 ETFs matters most to you. 4 ETFs, 4 jobs. Let me introduce 4 ETFs. They all pay dividends, but they are doing 4 different jobs. Think of them this way. 4 people who all want the same outcome, stable retirement income, but take 4 different roads to get there. The first ETF is SCHD, the Balanced Core. This is the fund built to do everything reasonably well. A current yield around 3.5%, dividend growth averaging about 10% per year over the past decade, rock-bottom fees at just 0.06%, and during the 2022 bear market, when the S&P 500 fell nearly 20%, SCHD lost only about 3%. It is the fund that protects you without sacrificing long-term growth. The second ETF is JEPI, and this is where I need you to pay close attention. JEPI pays around 7.5 to 8% in income right now, monthly. That sounds incredible. And for retirees who need income today, especially inside a tax-sheltered account like an IRA, it has a real role to play. But here's what the YouTube thumbnails don't show you. JEPI uses a covered call strategy. That means it sells the upside of the market to generate extra income. When markets recover from a crash, JEPI recovers slowly. It captures only part of the gain. More importantly, JEPI's dividend is shrinking. Over the last 5 years, its income payout has declined at an average rate of about 8% per year. The yield you see today was higher 2 years ago. It keeps drifting lower. For a retiree who needs growing income to keep pace with inflation, that's a serious problem. JEPI belongs in a retirement portfolio, but in the right position, as a satellite holding inside an IRA, not as your core foundation. The fourth ETF is VIG, the long-term compounder. VIG owns 338 companies with track records of growing their dividends year after year over the past decade. Its 5-year annualized return is 15%, the best of the 4. And it holds over $120 billion in assets, making it one of the most trusted dividend ETFs in the world. The trade-off is yield. VIG pays only about 1.6% right now. For a retiree who needs income today, that barely covers coffee. VIG belongs in a retirement portfolio for someone who is 58 or 62 and still 5 to 10 years from drawing down. The fourth ETF is HDV, the Defensive Fortress. HDV holds just 75 companies, concentrated, conservative. 71% of its portfolio is in consumer staples, energy, and healthcare, the kinds of businesses that keep selling food, medicine, and gasoline whether the economy is growing or collapsing. During the 2022 bear market, HDV was one of the only equity ETFs to post a positive return. It is the sleep-at-night option. The cost is growth.
Let me show you a specific allocation. A $500,000 retirement portfolio, 60% in SCHD held in a taxable brokerage account, 25% in JEPI held inside an IRA, 15% in HDV, also taxable. At current yields, that portfolio generates roughly $1,850 per month in dividend income. Now, here's what makes dividend investing different from almost every other retirement strategy. That $1,850 per month isn't fixed, it grows. At SCHD's historical dividend growth rate of around 10% per year, the same $500,000 portfolio, without adding a single dollar, could be generating over $2,400 per month within 5 years. Not because you invested more, because the companies inside the fund kept raising their dividends. That is the variable most people miss when they look at yield percentages. The yield today is just the starting point. Dividend growth is what changes the retirement equation over time. One more thing worth knowing. The One Big Beautiful Bill Act, signed in 2025, created a new $6,000 deduction for seniors age 65 and older, and qualified dividends, the kind SCHD pays, are taxed at 0% for couples with taxable income below about $99,000. Many retirees with modest Social Security income and a dividend portfolio like this owe no federal tax on their SCHD dividends at all. This is not tax advice. Please talk to a qualified professional about your specific situation, but it is a conversation worth having. Carol and Jim from Tennessee didn't need to change anything. They just needed to understand what they owned and why it was built for exactly this. Let me leave you with the one sentence I want you to remember the next time the market sells off and your neighbor is panicking. Write this down if you want to. Stock prices panic, dividends don't. That's not hope, that's history. When the market is selling off and the headlines are frightening, that sentence is your anchor. If this video helped you see your retirement portfolio differently, share it with someone who needs it right now. The market is making a lot of people nervous. This could give them something real to hold on to. Drop a comment below. Which of these 4 ETFs are you holding or thinking about adding? I read every single one. And if you're building retirement income and want to stay ahead of changes like this, subscribe to Dividend Hustle. I cover everything that protects your income in retirement. Next video, we're going inside SCHD's March 2026 reconstitution. The fund is about to change. I'll show you exactly what's different, what it means for your dividends, and whether it makes SCHD stronger or weaker heading into the rest of the year. Don't miss it.